Bueno.
Well, good afternoon. I am Álvaro Guzmán de Lázaro, and I would like to welcome you to our 8th shareholders meeting. It's the 8th for Azvalor, but it's the 21st all throughout our career. Like other years, there will be a first part of the presentation, which will be organized by the founding members, Beltrán Parajes, Sergio Fernández Pacheco, and myself. And we will also have Javier Sanzano, who is in charge of Azvalor Managers, as well as with José María Márquez, our partner in Davalor, and whom I'm certain you've known and you've met before. After done, we'll have a Q&A, questions you've sent our way, and we'll try to answer all of them, although, as we all know, it'll be difficult given the limited amount of time we have and the huge amount of questions we've received. Thank you very much, everyone, to all of you who sent us your questions. And well, in order to open this 8th meeting, it's not only a return to tradition, but it represents the year where the liquidated value has gone over 200 euros per share, doubling the money we had 7 years ago. It's the year where we've beat all indices with more profitability than ever before. And this has been the worst year for an average portfolio in over 50 years. It's also the year where our shareholders, yourselves, have a positive profitability, but profitability above indices, no matter when you've invested. And we actually are very proud of meeting these milestones, which reach the core, which is the trust you've deposited in us, making sure your money is worth more. Having said this, and I want to underscore our pride, what really fills our heart with pride is how we've achieved this. And the fact of the matter is that after 7 years, we can finally say that Azvalor has an appropriate investment culture that doesn't rely exclusively on Fernando's or my own good practices or brilliant analysts. But this is, trust me, much more important than the results. Our investment culture, an investment culture, has two ingredients. On the one hand, an analysis process, and on the other hand, an outlook before market fluctuations. As far as the process is concerned, Fernando and myself have strived these last 7 years to make this explicit, dividing it into phases and talking about each individual aspect. Whenever an analyst comes and joins us, has this roadmap, and it's already written down for them. And trust me that this roadmap goes beyond reading a procedure manual. As for the second part, facing the fluctuations, I think that that's the most important part, which is what really sets us apart, because it means that you have to buy when everyone else is scared and selling when everyone is riding high. This is something you can't teach. You have to live through it, which means you need time. And after 7 years, we can finally say that we already have this. What do I mean by this? Well, we have to live together as a team. The process of buying a share, seeing it fall 90%, choosing to buy more as the storm rages around, even when you're being mocked, so that in the coming years you can see it rise by 25-fold. And I'm talking about this. And when our team sees this, we start believing, and it's only then we can finally nest all throughout the house, all our salespeople, in our investors, communications, and even our legal department and compliance departments, the true essence. That's when we realize what we do. We take advantage of market fluctuations in the short term, which are always capricious, to invest in the long term, and in turn protect and grow our capital. Now, 7 years after launching Azvalor, I can guarantee that we have a finely tuned machine. We're working hand in hand means we can tackle a larger investment environment with finely tuned analysis. which is why, as I mentioned earlier, this is the most important thing this year. And of course, 2022 is a year where we can celebrate. And of course, having portfolios that are twice as much as they were earlier is wonderful. But as a company, what we're proudest of is that we can guarantee that we've got an explicit process that not only relies on my abilities or Fernando. So it's wonderful for me to see how our team has worked all throughout this year, like Fernando and I have in the last 25 years, having shared all this experience in an explicit process, rigorous process, and this, without a doubt, is going to make us all profit beyond strengthening Azvalor as a company. Having said this, well, let's go to the presentation. I'm not going to talk about profitability. I already mentioned it, and, well, that's the past. And, well, we have to look to the future. This isn't working, so if you can just go to the next slide. Well, what a smashing beginning. We have to go to the next. If you could skip over this one, which is, again, the past. Well, we always start our presentations by showcasing what we can expect from the global economy. You always ask that. You've asked this in the last 23 years, and we always say that it's irrelevant, and we always show this slide. So why mix it up? We've been doing this for 23 years, and the fact of the matter is that the world is growing slightly less, but it's still growing reasonably, and the developing world is growing slightly more than the developed world. And with these predictions, I think, well, this is enough for us to take advantage of our process and keeping on finding value and worth. And having said this, I'm going to stop here. And Fernando, you've got the floor. Alvaro has talked about how stock markets have fallen, but these have taken place in a highly inflationary environment of around 10%. And there are independent measurements beyond the official ones that point to even higher rates. So actual falls and the damage that most investors have suffered is even higher than it would appear. And it really makes our portfolios shine. Profitability and differential, these are objective data we can offer. But in our 2022 results, we've got other very important achievements which aren't as evident. One of them pertains to achieved profitability. That is to say, its efficiency as we see it in profitability adjusted by risk. Warren Buffett said some time ago that the actual test of a conservative portfolio can be seen when the market falls, which is, well, when the tide falls, you can see who was naked. So this is value investing. And sometimes we don't really pay attention to this. And this means that you don't only get long-term profitability above the market, but this makes it safer with a lower risk of suffering permanent losses. The importance of these thoughts can be evident, but it's usually undervalued. Owning a collection of active bonds properly managed and bought at good prices is what really protects you from adverse effects. The results of our portfolio haven't been good because we've had the best possible scenario, but because our investment had been bought taking into account the worst possible scenarios. That is what we think when we invest. First, we focus on risks. Then we try to crunch the numbers for the worst possible scenario and the impact it can have on our investment. And we only buy when that specific investment can get over that test. So that's why we say that Azvalor is, above everything, a good refuge for your savings. Something else that shows that this is so, the really low amount of errors and mistakes. And finally, the data, which is that most companies that we sell after having won money even grow even further. And I think that this beyond profitability is proof enough that the process is robust and that we are very conservative in our gauging. I also would like to take advantage to amend the totality of some of the criticisms we've received as far as good profitability, but we've incurred a lot of risk to get these. And it's actually the opposite way around. It's the opposite way. Profitability is good because we bought cheap, trying to minimize in all of our investments the likelihood of permanent losses. The second achievement, less evident from outside, is the value we generate in our portfolios, which is as important as achieved results and an omen of things to come. So in 2022, well, this has been a wonderful year with an increase of our international value of about 50%. The pronounced falls in international markets while our investment grew is ideal to generate value and to generate a lot of it. This environment has allowed us to renew the potential of our funds by rotating, buying low and selling high, sowing in order to reap good profitability, which means that the potential of our funds, Azvalor International and Azvalor Blue Chips, as you can see, is in the environment of 100% even after the wonderful profitability we've seen, and taking into account that we still have a high level of liquidity, which gives us a good margin to improve this potential, a potential which historically finds itself at very high levels, which are very encouraging. And I would like to also talk about Azvalor Blue Chips, our blue chip portfolio, which is value in which we can keep on investing whenever we close Azvalor International, which might be closer than we think. Beyond the prospective potential, we can see 92%, as we can see here, 22% in our ROCE. We believe that blue chips will be a wonderful destination for your savings. This fund, given its nature of investing in large cash-infused companies, we're talking about 20 billion, has a huge amount, it has huge potential for growth and a strategy where we can already show in our previous stage that we can beat the market by 3 or 4 percentage points. And, well, we're close to 11% in profitability year on year. And insofar as this profitability, we believe, is a very good indicator of the profitability we can expect, this would entail tripling our capital every 3 years. And, well, trust me when I tell you that we, partners and workers, are the ones who invest the most in Azvalor. Then we've got Azvalor Iberia, which isn't the ugly duckling anymore. We've got profitability of above 11%, over 19% in 2022, and in over 12% in these 2 to 3 months we've seen. It's got a very attractive potential of about 80%, and we invest in very well-known companies, which we've known for a long time, and good business, as we can see our ROCE of 34%. This is a fund we believe will keep on bringing us good news. And finally, Azvalor Global Value, our pension fund, with a potential of about 100%. This is the most romantic thing we do, because at the end of the day, pensions are very important for everyone. And, well, the fact of the matter is that, as we've explained on many occasions, given the fact that it's very similar to permanent capital, it's the one that best matches our investment profile, and we still have a long road ahead. We're talking about 80 million, and when we compare it to the 1 billion which we managed in the past, and I highly encourage you to take this into account. And having said this, well, Centrano, you've got the word. You've got the floor. Azvalor Managers has entered its 4th year And we've got about 60 million euros under management. And, well, I would like to thank the about 1,000 investors in this fund and the trust you've given us. It recently received a 4-star qualification from Morningstar, AA citywide. And last year, it got the best equity fund from El Economista award. And, well, we've been basically flat, 0.025%, whereas our companies in portfolio had improved when we took a look at its cash flow. So we've reduced that, we've increased dividends, we've organized buybacks, showcasing the strength of their situation as well as adding value to all shareholders. This connected to a huge fall in markets, which has allowed us to invest in new companies, very specific opportunities, means that the fund has the best portfolio from the get-go. If we take a look at the companies which have detracted the most in the profitability 2022, we don't think that this has been a permanent loss of capital, and we've got a huge amount of potential. And the ones that have grown a lot, we've cut back on them to rotate capital and go to more interesting opportunities. In this respect, very few companies have left our portfolio throughout 2022, and the key exits have been, well, basically given companies that were IPO'd. So, for example, the paper company Versa Corporation, Atlas Air, or the hotel company CorePoint Lodging, which were, well, a lot of companies were bought out in the last couple of years, about 10 and the prices we are talking about plus 30 to plus 270%. So Azvalor Managers really shows, we're talking about 70% are small companies, very small companies, which have very interesting prices, which means that, well, this is a wonderful testing ground to attract other investors, be them investors or financial or industrial investors. And, well, actually, when it comes to valuing, a year ago I was telling you right here that our price profits ratio was about 50%, 50% discount to the market. Well, given the wonderful evolution of the companies, our price profit ratio is in about 4.35%, which is the lowest level it's ever had in our fund. And it entails over a 70% discount when compared to the global share market. And profitability per dividend is higher than ever. And Donald Smith and Company was telling us, one of our 4 managers said that about 72% of the companies in our portfolio are in buyback programs, which is, these are records in the 40 years in their 40-year long career, and it really showcases the strength of our companies. And organizing programs at these prices, well, it means that we add a substantial amount of value. And take a look at prices which we hadn't seen in companies ever since, well, the 2008 crisis. And, well, Azvalor Managers, from the get-go, we've had a profitability of about 45%, which means 9.5% over year. But given everything I've mentioned in the last couple of minutes, we strongly believe that the best that this fund has to offer is yet to come. So thank you very much. Wonderful. Well, as far as the activity data of the company throughout 2022, we've closed the year with, well, the highest growth ever since Azvalor's dawn. And I don't want to give any data before thanking all of you, because at the end of the day, you are really the people who bring value, and we have to thank you for giving us this value. And I would like to thank our team, especially our management and analysis teams, given the wonderful, wonderful results, which have really helped the figures I'm now going to show you. As far as new investors are concerned, we have over 5,000 new investors, out of which I would like to underscore that about 50% of them, some 2,400, went to pension funds, increasing the amount of share participants in over 100%. Growing is always great for Azvalor, but it's much more important how we grow than how much we grow. And pensions, given its semi-permanent value and status, is what makes us feel calmest. We've grown 33% shareholders, and it's the first time we've closed over 20,000% investors, which is an outstanding figure, but it's a minority when we take a look at the 16 million investors we have in funds and the 300 million who invest. As for net income, we've closed with 336 million euro net, which added to the $500 million, given the high increase of funds. We've closed the year with an amount of total assets of 2.39 billion. That's a growth of over 64% when compared to how we started the year. And, well, it's a huge amount of growth. And the total perimeter of Azvalor's management has increased in over 500 million. And, well, using this, we don't want to stop looking for solutions that bring value to society and our investors. So I want to tell you that we have launched our first employment program. The appetite for all of these programs, permanent capital, and the modification of the 12 law for 2022 for employment plans means that these plans are the best investment plan for Azvalor to be. And in 2022, we closed an agreement with a Spanish company, a multinational, which has allowed us to have enough critical mass to tackle this project with all success. We already have over 40 billion euro and 1,300 investors, which united to all of the investors we have, we've got enough of a critical mass to start this project. As far as the good data from the company, I would like to share once again with all of you my congratulations, because, as I said earlier, we believe that you are, in terms of at least 50%, you are responsible for about 50% of our success. Basically, the success of an investment fund doesn't guarantee. This is a problem all investment funds have, in which the difference between profitability and what the investors get, well, there's a huge gap, and it's usually detrimental to investors. Last year, we showed you the Peter Lynch example, our admired investor for Fidelity Magellan, which for years had wonderful profitability, and still most investors didn't take advantage of even half of its profitability, and most of them even managed to lose money. This isn't a singular case. This is something that, as we can see here, this is the behavior gap. So it is very common, far too common, to have a situation such as this one. And the fact of the matter is that most investors, well, we are subject to several factors which lead us to do the worst possible thing, which is to invest only when we have, like we explained when we started, we need a robust process and praxis that has been grown throughout years. We need to have skin in the game. All of our wealth is invested in our funds so that we can show that we add value in the long run, and that these aren't just like flashes in the pan. And of course, investors have to be aware, and this is all key in order to be able to reduce this behavioral gap. And of course, your role, once we have these situations, to invest and to let money work for us, and we only change our minds like we do when the situation changes. So I am delighted to show you the results of the analysis we've run and all the investments you've had in all investment to see if this gap also takes place here in Azvalor, and I'm delighted, honored to show you these results. Average profitability in all euros invested all over Azvalor from the get-go, from when we started 7 years ago, is of 57%, which is really wonderful if we take a look at the harsh times we've lived through, and that this profitability is compared to the overall average invested in all funds, so capital funds and pension funds, which are less profitable. When we take a look at the mode, the result is amazing. What this shows is that the most repeated result is 92%. This doesn't only show what we have. We are, at the end of the day, an investment holding where we all play a role and where responsibility is divided 50-50 between investors and our management team. And another analysis, which is something we are proud of. If this were to work, it would be wonderful. It's not working. Now it is.
And that is the average investment term of investments in our funds, because you can't get return on the short term. It needs to be invested for a long period of time. And although this happens in a very short period of those investment periods, we don't know when it's going to happen, so that's why we need to be there. These are actual metrics about Azvalor. It tells us that as an average, our investors stay with us about 6 years. This is very noticeable, taking into account that the company is only 3.3 years old. And also very striking is a very high number of investors that have invested with us. The old investors, the first ones to invest with us, they've already been vaccinated. They've gone through several tests, which means that they have the courage and the capacity to invest in funds like ours. Those who have come recently to Azvalor, you will be tested as we have been tested, and I encourage you to try to overcome these tests if you want to achieve returns as the ones we have achieved. And I encourage all of you that in that 50% of responsibility that you have, you make those good decisions that will allow you to capitalize on the good results of Azvalor. And why not? All of us should try to beat our admired Peter Lynch. Thank you. I'm going to focus in the next few minutes on a few details on the indicators of Azvalor activity in 2022 and some regulatory news that I think you should be aware of. So 22 has been a historical year for Azvalor, not only for our return, but because of a high volume of activity, which has grown exponentially, doubling that of 2021. That thanks to our technological platform, which is the operational engine that supports all of this, and that we have been working on for more than 7 years. Along those lines, last year, we processed almost 21,000 operations, which is doubling the number of the previous year. As Beltran said, more than 5,000 investors, an increase of 33% compared to 2021. The Center to Care for Our Shareholders answered about almost 10,000 calls, 41% more than the previous year, and all of that with only 2 incidences, which gave rise to claims. From the point of view of digitization, that we've talked about in all our conferences, and we've always said that it is a strategic target for the company. You know that you have several things at your disposal. First of all, you can join 100% digitally, onboarding digitally with all the guarantees and complying with all the requirements established by the law. Last year, more than 872 people decided to join us this way digitally. And 97% of transactions are done 100% digitally. And we think that this is an easy and good service for all of us investors, but it's also a competitive advantage for the company because it eliminates managing documents. And let me remind you of the advantages under the PSD2 directive on electronic payments. You have it at your disposal. you can make direct payments under this directive. So when you sign the order of subscription, you can make the banking transfer at the same time. And lastly, in this part of digitization, I'd like to insist on the significance of recurring savings on the long term, and and this is excellent for our funds. Last year, we processed almost 3,700 transactions of this type by 500 investors who are already using this functionality. From the point of view of the digital media, we had 120,000 views in YouTube. We have more than 2,000 and another social medium, and our web received more than 1,330,000 visits. And just a few comments on regulations. We have a wide range of institutions and supervisors that supervises. There is a list of them. And this year, there have been 3 new things regarding regulations that affect all of us. One of them is the regulation that changes fundamental data. It is the prospectus that you sign when you do an operation with us on the description order. The EU changed the regulations and made this document more transparent and comparable for the investors. And the CNMV approved a circular letter, which entered into force this month, where it changes the methodology to change return scenarios, levels of risk, and the cost indicator in order for that information to be more easily understood by all of us. And finally, in September of last year, the law was passed to create and make companies grow. And there we have the institution of collective investments. And it eliminates the fact that we don't need to do quarterly reports anymore. So from now on, we won't no longer draw up quarterly reports, and we will have an annual report and another report halfway through the year. I think this is a very good measure, and it does defend all our interests because it defends our greatest asset, which is intellectual property. So we don't have to give details about our portfolios on a quarterly basis. And finally, the European Digital Operational Resilience Act, known as DORA, that's a clear example of what the CNMV and regulators are doing regarding cybersecurity. This is going to require that we increase even further the strict controls and procedures that we have in Azvalor. And that's all from me. I'm going to hand over to Jose Maria Marquez. Alvaro is the head of Africa Director. That is the NGO that we've been working with for a few years now. It's part of our social corporate responsibility policy. We've mentioned this more than once. We have a remuneration policy that forces all employees to invest at least 25% of their variable remuneration in Azvalor funds. That's 50% when it comes to partners. We also have initiatives that affect training, financial education. We collaborate with the Complutense University in Madrid with summer courses. We also participate in the master's program or value investment. We also have different initiatives that have social impact in collaboration with Aguara, the Foundation Madrid Estela, the DAM Foundation, and the spearhead of all of that is our Azvalor project that we're very proud of, and Jose Maria will describe it in more detail. But first of all, I think he's prepared a video for us to watch.
Quiero enseñaros la granja de Odokibo, donde este gesto.
This is the Okodokido farm in Uganda. All these things are possible thanks to the effort of Marian Brothers and to Azvalor. This is the beginning of a long road ahead because now they can cultivate rice and sell it. And that is how the farm started to grow. And with the help of Azvalor, they built a primary school and residence for the secondary school students. This year, thanks to the help of Azvalor, they've opened the new Technical Institute Isabel Mateos, where they teach things like mechanics, catering, agriculture, etc. Let's meet some of our students. These are some of our students. They study farming. They are sewing. How's it going? Great. Hi, Viola. Hi. Let's go into one of the classrooms. This is a sewing class. They're in the middle of a class, so we're not going to interrupt. Let's go to the refugee camp now, another of the projects that we're working on. See you in a while. Thank you. Thank you. Congratulations to all the co-investors, the donors. Thank you so much for making this possible. We've seen a video. This is an example of just a few weeks ago. That was for Rebecca. She's a nurse, a Spanish volunteer, and she was showing us what's happening in the north of Uganda in one of our projects. As you've seen, we started with water. By the way, when the driller started working there, they didn't find any water, but the Marian brothers said, no, we're going to keep drilling until we get some water. A lot was at stake. They needed water, and they insisted. And thanks to their effort, their hard work, and their commitment, at the end, they did get a lot of water. And thanks to that, they're sowing rice with 50 Spanish volunteers who have gone there to help them, engineers, nurses, agricultural engineers. Well, the agricultural engineers introduced a variety of rice, which is giving excellent harvest. So now the Marian brothers could do a lot of social projects, as we have just seen, building schools, a primary school, secondary school. They financed part of the building, and the other part was financed by Azvalor so that it could be sustainable. You can see that we're also using solar panels. This is a refugee camp, and this is a second slide. I don't know if you noticed that one of the girls was called Viola. The girl, she said, "Hi, Viola." Well, she escaped for southern Sudan 5 years ago from an area that is called Yain. To the north of that place, I remember I was there once with women who said that they needed help to have a more innovative farming system. And we're talking about things that the Phoenicians brought there. And this girl, Viola, needed the hoe, and well, she said that she had escaped from that area of war. They, as you know, they're in great danger there. They're raped, etc. So she went to the refugee camp. She walked there. She left her family behind with a promise and hope of getting, learning things and being able to go back and help their families off. And in southern Sudan, well, you know, the situation is very difficult. Well, Viola is one of the many of beneficiaries of Azvalor who is studying in this technical school, Technical Institute Isabel Mateos. As you can see there, we've already worked on 100 projects 3,100,000 euros have been invested by Azvalor thanks to the generosity of investors and donors of Azvalor. So that's about 30,000 per project. But there are some very large projects. They built secondary schools that takes hundreds of thousands, others less, because so there every single cent gets to these people. We're all volunteers, and we love every single project if it's only worth 3,000 euros. And to end, I'd like to thank all of the co-investors and donors, the people who are working there in the field, also the volunteers who go there. This video that we've seen is one of the 100 projects that we're working on. There are a lot of people who say but don't do anything, but Azvalor people do much more than they say, and we do everything we can because this is what makes us happy. It is wonderful that we are creating this value for all these people. Thank you very much, everyone, and congratulations once again. Thank you, Jose Maria, for allowing us to do these things. You do a great job. Okay, so very quickly now, I'm not going to say a lot. We're going to start the Q&A session. I think that is the most interesting part of this meeting. And the results of last year don't come from last year. It's from the previous 4 to 5 years. So we feel very comfortable with what we've sold for the next 5 years. We have very good portfolio, very robust portfolio. And what Fernando and I feel as the most important thing, because it was the most difficult part for us, is to make this a reality. We had this in our head, and now we have an investment culture. That's what we were looking for. And it permeates the whole of the company, not only the investment department. I'm going to leave it here. And why don't we begin the Q&A session? Right. Great. So before we start, thank you so much for all your questions. We received more than 100 questions. This year, we asked you to send them beforehand so that we could be more efficient in reading and answering your questions, so we can answer more questions. So it's 6:46. I think we can read about 40 to 45 questions, like 2 to 3 minutes per question. That will take us about 2 hours. We don't want to keep you any longer here. So, Fernanda, why don't we start with the first one? It's about China. A participant, Javier, says, going into China in 2023 might be a good option given the progressive opening up of the country and the increase of consumption. What percentage of the portfolio could you invest in this country? Well, this is a very interesting question. I remind you that what we do is to generate valuation with a level of confidence of 90%. Valuing a business basically has 2 legs to it. One of it is understanding the business, and the other one is understanding the people who are managing that business. In China, the business, yes, we can understand if it's whatever, distribution business or steel or whatever. But the people part, we would not be able to get a 90% degree of confidence in the valuation of a company. There are places where we just can't do it. But it's a good question and very interesting indeed. So how can we invest on a trend that we think is interesting? Well, in the fund of managers, Javier has been looking for Chinese managers for some time now. He's met with 4 or 5. So if we find a good Chinese manager that can give us the confidence we need, we might invest there. But so far, we haven't. in any case, indirectly, we have investments in China because there are a lot of global businesses that have a presence throughout the world and therefore also in China. But because of Alvaro said that is the most efficient way we have to invest there. You remember that we talked about BMW, that China had a very good market there. So our fund indirectly is invested in China. And I think we should also mention the danger of establishing cause-effect relations that are very simple. If China is going to grow, then it's good investing in China. It's not always the case. In fact, I remember from 2007 to 2017, which was when China was growing at rates of almost 10% every year, the Chinese stock exchange was a very bad investment. So we shouldn't reach these conclusions. I think it's much better if you look at it bottom up. This investor says it looks like high inflation is over and that the golden shares haven't contributed as expected. Do you wish to have a percentage of gold in your portfolios? Well, the way you pose the question, I think, it's making a lot of assumptions in terms of causality. First of all, top-down macro. And, well, I would say, or I would answer with some questions. High inflation is over? Well, I don't know. How much is high inflation? And what is the specific function of the relationship between inflation and the price of gold, and between the price of gold and the price of minerals that we invest in? We're invested in Barrick Gold, which is a company that is listed right now at the same level that it was a few years ago when gold was at $1,200 per ounce. Now it's $1,080. Or seen differently, it's very much below when gold was $1,200 per ounce. It was 50 per share, now it's 16. So at the end, what inflation are we talking about? CPI, the Austrians say that CPI is a symptom and that inflation is growth of the monetary mass. Are we referring to consumer price index, or are we referring to inflation? So what is the role there of interest rates or interest rate expectations, nominal or real? I think it says that high inflation is over, and the shares of gold have not yet paid back. Well, going back to the price of gold, it's very difficult. He talks about inflation and gold as if they were directly related. Why did gold go up in 2020? When the concern was deflation instead of inflation? Gold did very well at the beginning of 2020, coinciding with COVID. So these are top-down rationales, complex and dangerous, I think. We have invested in a small collection of gold or companies, a small collection of the many that are listed. And we've done so because we think that there are a combination of good assets, good balance sheet, their management we like, and at a price that we found attractive. And I can assure you that we don't make any absurd assumptions to calculate the price of gold. That is what we do and not using those macro rationales that are embedded in the question. The question says, gold has not worked. We bought Barricat at 15 and sold it at 30. So there we made 100%. And then it went back to 15, and then we bought more again. So the reason is that the market is getting ahead. So when Barrick went up, there were people who were thinking that inflation was around the corner, and now the market is thinking that there's going to be an increase in interest rates, and that's going to halt inflation. It could be. Maybe politicians dare hike interest rates. I'm not so sure, because lots of things happen when there's an interest rate hike, and they're all bad things. So if there's not an increase of interest rates beyond inflation, Barrick will go up. And if there is that hike of interest rates, what will happen? Well, what happened in 2020, Barrick will outperform the market. Given the same situation of bubble, let's think about the 20s and 70s, the two responses generated the same thing. In 29, it crashed by 80, and then Barrick did 60% better. And in the 70s, where they chose inflation, gold mines grew a lot every year. So I understand the question, because if you think that it hasn't worked, if you have gold and we're 8-10% inflation and it hasn't worked, well, it has worked. And Barrick, all of us here made a lot of money, and we sold. That's another part of the work we do. But that was just a small remark. There's a question from another investor. He says, if there were a recession, inflation would not fall, don't you think that would be the perfect situation to hold on to that gold? I think we answered already. Great. Another investor, if the probabilities of having a recession in the short term, what would be more appropriate, investing 100% or having part of the portfolio liquid? The question assumes that if there's a recession, we know what to do, and that we know when there's going to be a recession. When we read the papers and the media, they force us to think what we should do in a recession. And I don't think it is necessary to know when a recession is coming to get a 15% a year, which is what we've done in the past 20 years. But you, as investors, I don't know if we have an annex on the shares of Amazon, Schindler. Maybe we can see that so that people can see it, and so that they won't want to see whether there's a recession or not, or think whether that is important or not. It's Annex 10. Maybe we can see it on screen, please. Let's take the example of Schindler. Until 2020, 23 years. We know that there was a very strong recession from 2007 to 2009. It's just a very tiny line there. If somebody in 2007 is anticipating a recession, buys out of Schindler, and does it and comes in later than he should, well, you didn't lose much. And the same thing goes for Amazon and BAT, because it isn't necessary. The media make us believe that it is necessary to know when the recession is coming to pull out. No, if you wanted to use the recession to pull out, you would have to do two very difficult things. You would have to get out 3 or 4 months before it started, and you would have to go back in 6 months before it ended. But that's exactly the case. Now, it's very difficult to know when those two things are going to happen. And if you fail for just a few days, you lose everything, or you lose most of what you gained. And because the 5 best days and 5 worst days of the stock exchange explain most of the return. But I think that we must always be invested. We, within our portfolio, we see whether there are opportunities or not, and if there aren't any, we have liquidity, and we have significant levels of liquidity. But it really is not necessary, as you can see in those graphs, to go into that debate. Although the headlines in the media make us think that it is necessary for us to have an opinion, it really isn't. It's not supported by the data. This investor congratulates us for our success with the funds in 22, and he says, from the beginning of 2023, we've seen that there's been an increase in the buying of bonds, and some investors believe that markets are complacent vis-a-vis fixed income. What is your opinion on this? I know that you're trying not to speculate, but do you think there will be a correction? Do you think this is the right moment to buy your funds, or would it be better to wait halfway through the year?
Well, we believe that it's always a good time to buy into funds, and I want to insist that there are many indicators that can point to a recession or not, but we can't. What we've done is yearly 15% between 2013 and 2023. We've done this with 2 falls of 50%, a recession, and, well, timing with funds isn't interesting. It's not useful, and like we've explained, this is the reason behind a manager such as Peter Lynch. No one in their investment fund follow them, because people buy when an investment fund is doing fine and they sell when it isn't doing. So I wouldn't market time with our funds because, well, it makes no sense. Okay. Let's see. Well, the best indicator for what we can expect out of yearly profitability in the coming years at the end of the day in long terms is the potential, and like I was explaining earlier in my presentation, funds find themselves in a situation which we, in our 20 years, are doing fine in the upper echelon, so that if people want to do market timing, well, it's a bad idea. This doesn't mean that maybe in the short term they can fall a little, but, well, that's the best reference that's the most attractive part of our portfolios. Juan want to ask us something. Whenever you invest in the type rate curve, in the rate curve, it's a good time. So what do you expect ever since we saw the beginning of this phenomenon? Well, this is us trying to predict whenever the rate curve is inverted. There are relationships between non-payments, and whenever this goes up, there's a recession. Whenever the amount of train loads decreases, there's a recession. So these are indicators, but I would not trust anything that seems too simple, because the fact of the matter is that reality is much more complex, and the fact, at the end of the day, the most efficient market is the fixed rate market. And, well, since it's the most liquid market and the most efficient, well, I think that this was in La La Land because we had 18 billion in negative, and then inflation was 9%. So the most efficient market, the brain of the most intelligent people in the world, and they can invest much more in fixed rate than in equity, and, well, negative rates, actual profitability 0, and 8 months later, well, these 18 trillion are falling. So, well, the fact of the matter is that you can never predict anything, and, well, there's such a load that when we've invested, this is true, but there are other indicators which I've mentioned, and we don't try to predict anything, but we do try to gauge, to diagnose if the economy is healthy or not, if it's robust or fragile, and, well, it's not. This isn't a very strong macro dynamic, but we see worrisome dynamics. The Fed has issued 2 trillion. They're printing 2 trillion after the vaccine in order to take inflation from 1.7 to 2%. 2 trillion because inflation wasn't growing, and it had to go from 1.7 to 2. The estate is an accomplice. I'm not saying that they did it wrong, but they printed 5 trillion. This is after having had 30 trillion in quantitative issuing in the last year. And then inflation went to 7% before Putin invaded the Ukraine. And when they took a look at this, the Fed said that this was transitory. Well, the Fed has made a mistake because they aren't investing enough. This quantitative easing because, well, you've made a mistake. Everyone makes mistakes. But you take a step back. But the Fed made a mistake on the mistake. And the Fed, when we take a look at the British Treasury, they started buying with 10%, and no one jumped out a window, but people understand this. Well, how are they buying funds well, the fact of the matter is we all know the answer. We have to buy so that we increase this, because if bonds increase, well, there's a collection of disasters. So, well, this is worrisome, and I don't think that you can cure inflation buying bonds at 4 when inflation is at 10. And people have to eat. So if inflation is at 10%, well, there will come a point where workers will ask for increases, which is reasonable because they have to keep their purchasing power. And no, the reason is that, no, they're not going to ask for an increase, but the 5-year curve, which is the reference, is at 3 or 4%. Good luck. Good luck. Whenever we sit with unions, rail unions have had a huge increase in the last 4 years. And, well, this is worrisome, of course, and these are things that aren't encouraging, but there are encouraging matters, such as that hugely substantial part of the world is middle class that's developing, they're saving, and, well, this generates a huge amount of opportunities. And, well, I just want to say that this isn't that simple, that let's not simplify. And even though we think all the time that we want to look for easy ways out in order to run away from dangers, but this ain't it, chief, as people say, as the youth says. But of course, we're facing a recession in our predictions, and we're not going to focus on this. We analyze next. We're not going to assume that the volume of clothes sold by Next are going to grow in the coming months. But if they decrease and we assume different things, we see that shares are low, well, we might buy even if we're in crisis, because it's very difficult, because it's much more complex than the simplicity we want and the media offers us. I liked that comment that no one predicts anything. Yeah, no, because the fact of the matter is that, well, definitely no one predicts anything worthwhile that isn't already discounted. There was some research that showed that out of all the hedge fund category that existed, macro hedge funds are the ones that work the worst. And no one says anything, and if it's macroeconomy, it's even worse. But when we take a look at the housing bubble, we didn't lose it because we saw it beforehand, and we didn't play. We didn't take advantage of the rallying, but we avoided the crash. So we didn't have amazing results. But having seen everything that was coming, you can't really predict when. No one predicts anything ever. Very good. Next question. More than a question, as a suggestion, an investor said that it would be interesting for us to create a distribution fund so that when the time comes to take advantage of the wonderful results our funds are enjoying, they can do it without worrying about losing their main capital. This is something an English fund does, and they believe that this is a good idea. Well, that's down to you, Sergio. No, well, all of our funds are cumulative funds, and technically the dividends we get from all the companies in which we invest, in the case of coupons and fixed rate, stay within the fund's wealth. They aren't divided. What this investor says, they have a distributive fund. They pay out dividends to give investors some liquidity. This is something we mentioned some time ago, and this was technically possible to design one of these funds to distribute. But the fact of the matter is that dividend funds that pay out, well, the selection of companies they have is within their investment company and their investment strategy. So conditioning our strategy and our investment culture, which is what we mentioned at the start of the presentation, as Salvador said, based on what they're going to pay and what do we invest, well, we thought it was far too much of a risk, and we don't want to tweak the foundation of our company, which is our investment culture. That really put us back. But then we've got an actual mandatory distributed fund in which they automatically give all participants, all investors, an amount that the management team chooses. But this has a lot of implications for investors themselves, and we thought that was just like, that wasn't really what I had to do. So we've analyzed this, and, well, the fact of the matter is that we don't believe this to be interesting, but it is on the table. No, and of course, what we can also do, because I think that some people do it, I have someone, they invest in the fund, and as they invest, they sign reimbursement orders in the 20 quarters every quarter, and they give you 0.51%, and you give yourself your own dividend. And I assume that has a tax implication. No, of course, that has an impact. And if someone has a need, they need liquidity, well, we can reach an operational agreement, a bespoke solution, so that their lives made easier. But at the end of the day, we're talking about that has a tax impact, and it wouldn't be a dividend payout, is what we're saying. We're saying that on December 31st, he's talking about an international fund, and they want to know if by concentrating all of our companies into our portfolio into 30 companies, risk would be reduced. Well, a high figure of companies, high number of companies associated to a higher diversification, which means that there's less risk and not the opposite way around. But it is true that having a far too high number of companies means that at the end of the day, you reduce the amount of control and knowledge you have over the same. So, well, we say that at the end of the day, investing without knowing our investments is not really investing, or it's misinvesting. And, well, we definitely have a degree of diversification, which is more than enough, and it's more concentrated than people care to believe. And the first few weigh about 60%, and in our Iberian fund, the concentration is even higher, and we have a huge amount of control, and so we've struck a good balance. So we've got enough diversification and a high degree of control over what we do. And I think that it has been proven. I can't trust some, but this doesn't reduce the risk of companies. At the end of the day, you have to buy cheap, and there are moments where there are very clear solutions which you have to concentrate very clear. I remember that we had 20% of our funds which were concentrated next door, and they were growing, and there are times where, not really, and you have to force concentration, and it's counterproductive. And if this isn't very clear, well, this means that there are 30, 40 companies with a potential of about 50%, and, well, these are the investments we've run. And some we've done, some we haven't. But we can't force things, and I think that 40 to 60 companies is what we always have. We believe that, I believe that most of our wealth, our financial wealth, you have all of this in a single one. No, we've got it in 40 companies. We don't want to have it in 10. Why? Because, unless there's an exceptional situation, which occasionally shows this, but, there are also minimum diversification rules, which means that there's a level of diversification that, as funds, we have to meet. I think that the minimum is 23 companies. And in the same line, I asked Javier to come up here because there's an identical question for the Azvalor Managers Fund, and the person said that the composition of the Managers Fund has 100 companies, and wouldn't it be possible that the profitability of this fund with such diversification is similar to an index? And Yeah, I think that's interesting. But following to what Albert and Fernando were saying, there isn't a magic figure for managers, and I think that it depends on several matters and the process, the investment process, what companies they're buying. And it is true that when you diversify your portfolio, you face several potential problems. First, maybe that you don't know the companies. In this case, when you have 4 different management teams, each of which has concentrated portfolios, there can be an exhaustive analysis. You've got 30, 35 companies, and then somehow, like I said, they can devote the time they need to each of them, and the amount of man hours they devote is very high. And then the second problem, which I think is what this question is really asking, is you buy so many companies that you're very close to what the market's offering. And well, I would say that Azvalor Manager has nothing to do with indices. Any overlapping with any indices is close to zero. And well, in this spectrum of passive management indexes, well, we are in the complete extreme of active management. And if we think of the kind of companies in which our managers invest, well, these are companies that are usually flying below the radar. So small companies that are in very specific niches, companies that, well, maybe institutional investors can't invest, or companies where it's difficult to invest, or fields where people, given fashions or panic towards certain fields, don't want to invest, which means that we have very different portfolios that are very different among themselves and applying very different processes. And they find there's a lot of noise there, and we can find very attractive prices when compared to the value of each company. And this means that the manager has a different portfolio to any single fund and to any other funds. And well, Javier, since you're there, I want to ask you a different question, which we received, which was further down the line, but I'll ask it now. Could you offer more details about the purchase offers that Azvalor Managers offered and what prices they reached? Yeah, well, when it comes to public acquisitions, well, it's what I said at the beginning. We have a huge amount invented in small companies, very small companies. And, well, this really... I think we have a slide with something which we used internally, where we showcase overall, well, be them competitors or clients or providers for that same company, which at the end of the day, they are trying to find efficiency and they want to get assets at a good price. And well, we have other ones which have been acquired by financial investors and especially by private equity funds. I don't know if you can see it here overall, but well, we've had companies which huge private equity companies have tried to buy: Apollo, Cerberus, Carlyle, and a long list. And we can see that this is a long list. We've got entertainment, plane leasing from different countries, which we can't see in this list. But we've got U.S. companies, Japanese companies, Australian companies, all sorts, and different sorts of buyers. Actually, last Friday, one of our companies, Latin American financial company, said that they had received a purchase offering from their from their main investor. So at the end of the day, this isn't something that's unusual overall. And I would say that this isn't part of our principle, of our main thesis when we look for companies. But of course, when you invest at a good company at a good time, well, the market usually... So this is why, which is why we have of these takeover offers. When you invest at these prices, you have different prices. And when you take a look at the at how everything's been diverging between cheap and expensive finds itself at a historical situation, and cheap things are very cheap and expensive things are very expensive. So this is one of the reasons why we initially thought that the best is yet to come for this fund. Thank you very much, Javier. And our next question discusses the liquidity level in all of our funds, and they're surprised by the liquidity we have in our international fund after the huge falls, not of the fund, but of the market in the last couple of years. And the question is, aren't you finding enough attractive opportunities, given the risk profile, or have you predicted future falls? Well, another prediction question. Well, no. We always want to be completely invested. The fact of the matter is that we value everything in a very demanding, taxing way. So we've offered 19%. Warren Buffett has done much better, of course. There are people who have done much worse than we have. Only 6 out of every 10 beat the market. So we don't buy something if we don't see a huge level of safety, a huge level of security. So, well, this means that we have to invest when we've got a high level of safety. And if it isn't clear, we're not going to gamble your money after taxes, because this is money that's already been, well, it stings when you lose this money. And I imagine the people who invest with 20% potential, they're not just dumber than us. They just that we might lose in a bullish market, we might lose part of the market, but we don't want to suffer in a bear market. And, well, I just want to mention that if there aren't many opportunities, well, yes, there are several companies which we can see are worth some more, 15, 20, 20%, but that's not enough for us, and we're asking for 60% to come very high quality companies, and if the business isn't that high quality, above 100, so we're talking about 100%. So putting this money in a 20% potential company, well, it really dilutes everything. So I would say that we have a huge amount of human capital invested in a huge amount of companies in a very important pipeline, which we've analyzed and which we are willing to buy. And we've invested a lot, and so we're well prepared. Okay, they're saying, what affects negatively global value and consolidation funds? Well, our global value fund is the same as our different funds. It's a pension fund, so this is the same situation for everything than for the rest of funds. And Alvaro said this: we have a 20-year-long career offering about 15% year over year, and well, we've gone over all sorts of crises, and even the financial crisis, like we explained earlier, wars. Very different geopolitical situations, 9/11, Brexits, pandemics, Euro crisis. So at the end of the day, what I said earlier, investing in good companies, properly managed companies, at the end of the day is long-term protection. It's a storm shelter, and that's how we invest. And our consolidation fund is somewhat different. We've got a percentage of lower profitability, and this is something for people who are close and they don't want to expose themselves to the volatility, in the meaning that we don't want to be unlucky. So this has an impact, because at the end of the day, market is volatile, and well, there are obviously a lot of sawteeth. So in this respect, well, this could be something that we can recommend. Volatility is something we've mentioned many times, and it's not a proper risk measure. It's part of the game, and well, depending on the attitudes when compared to volatility and how you invest, well, you take advantage of it. But, well, this is something we have to live with. Like any other liquid markets, this isn't like this is markets, currencies, good markets, and at the end of the day, final volatility is the price you have to pay to have daily liquidity. So, virtue of being able to buy and sell in the afternoon, buy morning and sell in the afternoon, well, that's what volatility entails, and there are people who have managed to reduce this. This is what we managed to reduce with private equity. Okay, well, the solution is to invest in every 8 years in our funds. And, well, next question. Do you want to participate? Well, I'm going to showcase it, ask it differently. This has increased, and this could lead to you having a solution. If this were the case, there are two questions. Would you participate in the governance of the company, and do you want to participate in the governing bodies of all companies in which you participate? Well, no, we have to be humble and do what we know. We aren't company managers. We are, if anything, analysts who can gauge. That's it. That's all of it. And sometimes you have to be more or less involved, and Buffett did it with U.S. Airways and Lehman Brothers. Well, it was, like he said, those were mistakes. I think he mentioned it in his letter today, but just like, I don't think that we bring anything to the table, and companies buying their own shares, and, well, I don't know, we don't really have any plans pertaining to this, and, well, it has the disadvantage that you lose liquidity, because at the end of the day, if you participate, you're an insider, and you have certain situations. In the case of Buffett, when he bought a full company, well, he didn't really care, but, well, we prefer to remain liquid in exceptional situations, which in the future perhaps, but overall that would be changing lanes completely. Well, and this is a very interesting question. Buy cheap, sell expensive. That's what value investing should be, and that's very simple, but the minimum price of each asset is limited at least at zero, whereas the highest, there's no ceiling, because some people are willing to pay. So it would make it easier to decide when something is cheap enough, but it would appear to be much more difficult, more arbitrary to decide upon a sales price. What strategies do you follow to have an optimal sales strategy? Thank you very much. Well, the strategy we follow to buy and sell is the same at the end of the day. It's price and value and the alternatives, and it's diversified enough portfolio, and, well, crunching value is what we do, and this is, like we've mentioned, this is an exhaustive process, and which at the end of the day gives you a final value, and we buy when we buy at a discount in the market, and we sell when we approach. But it's not easy, of course, and when it comes to buying, of course, there are companies which at the end of the day we've got value traps. There are companies that look cheap, and then they're not really cheap in the case because they've been disrupted, be it, new technologies, or there's a change in consumer behavior, or maybe where people steal from us, or the board of directors or the managing body dilutes the value of the company by not allocating capital properly. Sometimes what happens is that regulators crush your market, and, well, that happens. Competition, of course, can get the best of us and do things better than we do, and take enough of a market share from us. So buying cheap isn't easy, and you have to be very careful, independently of what's happened. And something that goes from 10 to 9, well, statistically, well, you go from 1 to 0 and you lose everything. And, well, that's a possibility, and companies crash, and we've had situations in which this has happened, and, well, it isn't easy, and, well, sales price isn't that easy, so you have to gauge and when we approach this and when we compare to alternatives. So, well, in the conference, someone says that once they went over to go over a double-digit profitability, you should distribute wealth among investors. Well, since these are closing questions, I'll answer this one. And, well, I don't know what the conference they're talking about, but returning wealth, what we're talking about is closing funds when they meet a series of requirements that mean that our historicals are in risk. So we're talking about 2.5 billion, which implicitly means that we think of 5 billion euros, because if the portfolio is worth twice, what we're doing is we're closing funds when we believe we're managing 5 billion euros. Another question in this respect, and not returning money, just closing or limiting how much people can put in. Another question in this line is, if we close everything, can we invest in pensions? Well, of course we can. Pensions are a long-term commitment, and what we offer, this is very similar to what we offer. It's limited to 1,500 euros a year, but we expect in our employment plans for people to offer up to 8,500. But this is a reasonable amount to keep our funds open.
And where there'll be more alternatives. So there we have the international fund. And the third one is more technical in nature. It says, could you explain how the closing would affect clients? Would it be a hard or soft close? Could there be a new opening if the capital fell below the maximum reference? Well, obviously, when the time to close comes, we'll have to include a condition which is objective for all investors, and that will condition the closing. There are ways of closing at a certain level, which would be to limit the maximum participation by part of an investor, or just limit it to one participation. So he would have to have hundreds of participations to invest a relevant amount. But that would be obviously communicated. There would be a change in the prospectus, and we would need the authorization of the ECNMV. Sorry, Beltran, can I add something to that? Under circumstances, well, this is not very likely, but the money could be given back to the participant, to the partner. Let's say the fund goes up another 100% this year. We have 5 billion under management, and our level of desired liquidity is 40% because we don't find anything. We would give back 20, if we're allowed to legally. That's what I would like to do. Let's hope it happens. That would be fantastic. Well, that scenario could happen because they don't allow us to have more than 25% liquid. Yeah, it's not always easy to find good investment opportunities. There's a question from someone who's been with us for 7 years. When you try to guess as an investor what the profits of the future will be, how long is your horizon? 5, 10, 3 years? How long do you have a company in your portfolio? What is the average time it stays in your portfolio? Like the CEO of Microsoft says, do you think that Google, they might, allow the elephant into the room? Okay, I see 2 questions there. At what term do we estimate a company when we evaluate? It doesn't really work that way. What we try to do is reach a certainty of a level of profit guaranteed with the right causality relations. I think it depends on the type of business. BMW, it's cyclical. You need to take into account the cycle and look for a level of sustainable profit, adding or subtracting the years close to the treasury. Let's say in 2026, and this year it's outperforming, then add the cash of the 2 years. If it's losing, drain the cash. If it is a business that is mature, but like Schindler, then the valuation is done differently. If it is a business that is growing strong, like technological companies, we would have to do it differently. There you need a longer-term view. Well, all of it is part of the process that I mentioned when we started. ChatGPT, that was what the question was about. Well, growth sectors, generally speaking, there's a lot of competition always. So suddenly TikTok comes along and nobody knew what it was, and then it hurts Facebook and makes it fall almost 50%, taking away market share. Perhaps ChatGPT can crash Google, I don't know. But at the price it is at, one must have an opinion on it. It's a very difficult question to answer. We like easy questions in the exam. Growth companies, JCDecaux, which is the world advertiser in billboards, it's doubled. It not always happens, but these questions are too difficult. And if you don't get it right, you can suffer 50% from one moment to the next, which is what has happened to Tesla, Amazon, and the like. Value and price. Buy cheap and pick the easy question in the exam. Sometimes what we do, and this is a very interesting exercise, going back to calculating profit, is doing it the opposite way. In other words, calculating what has been discounted in the share price vis-a-vis the profit. We've explained this on previous years. When whatever is listed at £3, we try to calculate what does that price entail regarding copper prices, because that was a copper company, on the long term as a residual value of a company. And then based on that, we calculate the probability of the scenario. When we see it's a very remote probability because it entails scenarios that seem almost impossible, then we reach the conclusion that that price is not right, and therefore it is an investment opportunity. And then we calculate, as Alvaro said, normalizing the cycles. What would be the value of the company based on an equilibrium price on the long term? But we approach the exercise from both sides. Right. This investor, Alvaro, says, first of all, I wanted to thank you for your effort and dedication and congratulate you for your results in 2022. My doubt is regarding the future of Azvalor. You're constantly talking about the importance of the long term, but I have doubts as to the very long term. Where do you think Azvalor will be in 20, 30, 40 years? Do you have a plan for your own company to last in the very long term? Well, that's what we explained in our introduction. Trying to company to last has been an obsession for us since the outset. But we needed to establish the foundations for a good investment culture. And that takes time. Culture is a process and an attitude. To look for the attitude, Sergio used a metaphor. He's a hunter. He says when a bear attacks you, you need to stand still and raise your hands and face up to the bear, although otherwise he can go after you and kill you. Very likely that he will kill you, yes, if he runs after you. So basically, you mustn't run. You must face up. And you, in Azvalor, you can tell the analyst, well, when the bear comes, stand still. The analysts, the salespeople who sell the product without faith, well, bears need to attack you for that culture to be believed. We've been attacked by several bears. The Oscameco, when we bought it at 14 and it went down to 7, and there was a very famous Netflix documentary that said that nuclear energy was the devil. So we stood still. And then in our company called Consor, that was another bear. It went from 30 to 3. It fell down by 90%. The public opinion saying that coal was going to disappear forever. We stood still facing that bear. Oil. Some companies like Dalaris and were doing badly, and we stood still, but we bought many more oil drilling shares. And probably in the company, some people had their doubts. Those who had been with us for longer didn't have any doubts. Sometimes you really feel like to run away from so many bears, but suddenly nuclear energy, its reputation changed from one day to the next. The bear left, and the price of this company multiplied by 5 in a year. So LSG, they talked about the safety of supply, and Consort went from 3 to 75, multiplied by 25, another bear that left. And then others went from negative to, being worth more than 100. There are many examples like this where the value is multiplied manyfold. But sorry I'm going for so long, but this is just to explain why we don't fear bears. And we actually look for bears, because that's where you can find an opportunity. Where there's no fear and comfort, there's no fear, but you pay a very high price. As Warren Buffett says, you pay a high price for being on the comfort of consensus. And buying cheap for us is the key. And for that, we need to face the war in the trenches. This is why the first necessary condition is an attitude vis-a-vis market fluctuations, so that people won't look at you as a madman. We have that. And after 7 years, we have that culture. But we couldn't do it before that. We needed to go through all of this. And the process is also important. You need to analyze things well. Otherwise, you should not act. But Fernando and I had this in our heads. And with all the things that have been working in the past 25 years, making it explicit is not only wanting to do it. It isn't easy. I'm going to try to explain the different analysis phases. Well, there are many. There's an accounting audit, like saying, is this person misleading me with the accounts? I'm not saying that they, do things with their accounts to fool you, but accounting is a very good approximation of reality. And if that reality, with that you have a certain bias, then it isn't that easy. There are many more gray shades to it. But apart from accounting, we have been able to, do a really clear analysis of where the company makes money, where does it lose money, why does it lose money here and make money there. We split it all into different pieces and try to get all that information. And then when you analyze a company, there are crossroads. If suddenly I find that this item has not been accounted for properly, what do? Do I leave the company and look for another one? Or because it's so cheap, I don't care? Well, if I don't find past market shares, there are sectors and services where it's not very clear who's making or who's losing market share. What do that I don't analyze? I continue to analyze. There are crossroads. Have the executives changed? The managers, have they changed? Suddenly they change. So do I think that they're going to happen again if I invest in the company and then I'm going to have another change in management? So there are many things that you need to analyze. What sources do I use when I look for data? Do I use brokers? Do I look for a consultant on the industry? Do I ask clients? Who is better and in what cases? Well, the solution that we have for this is to approach all these things with homogeneous staff, with tools to solve the doubts that come up at every crossroad, making it explicit who are the best interlocutors for every type of question and what is the best way to address them. Believe me that this is very difficult to do, and when we've done it, we have to walk the way. Fernando and I, well, for more than a year, we've had weekly personalized sessions with each one of the analysts dealing with all these things. And it's them that help each other now. That's what I said in my introduction when I said it's beautiful seeing how our 25 years experience is affecting other people. Even the process we have in recruiting analysts has changed. Now there are many phases. A candidate has to go through different tests, qualitative tests, quantitative tests, personality tests. They have to do an example with a real case, 4 hours in our office. So it's a very long answer. I'm sorry about that. And perhaps I'm not actually answering the question of where Azvalor is going to be in 25 years. But we know what we need to do to face the bears. And I think this is going to generate a good performance in the future, whether we are here or not. And that gives us a great deal of satisfaction. And we think that is a guarantee for our participants. We're going to continue to be here. We're not going to go anywhere. But we can play sports every week and not have to wait for the weekend. We can do it in weekdays. I think you explained it very well. As you said, that takes time because that's the way it is. You need to navigate all these things. But we've done a lot of tinkering, a lot of trial and error. We've made lots of mistakes on the part of making the process explicit, in dividing or splitting tasks into different parts so that they can be studied in detail. It took some time. And now, at last, I think we have achieved it. Yes, the person who was working as an intern with us, with this process, very clearly he knew what he had to do and how he had to do it, and that added a lot of value. It's very difficult for somebody without experience to add value from the outset, and that took some time with trial and error, but we've come this far. There's a question about fees that I will answer myself. The question is, management fee. Is there a plan to reduce a management fee to lock in customers or customers that have more than a fund? Let me answer this question. What I would tell this gentleman is that what really locks in investors is not the management fee, that it is a performance, the average return that the funds can obtain for you. And the fee is a variable of that performance. Jose Enrique, I read your question, and I went to look at your account. He invested in June 2019. This is March 2023. He multiplied by 2 in 3 years and 9 months his investment. In this period, we charge him 6% fee. I ask you the question, how much would you be willing to pay to double your money in 3.5 years? And the second part of this question is there any fee, management fee that can lock in a person in exchange for a bad performance? The return of mutual funds is of 1.5%. That is the average. And in pension funds, it's 1.1. So my question is, what fee or what reduction of fee do you think would be necessary to lock in a investor to whom you are adding no added value? Because in Azvalor, we multiplied 2.2 by 2.2. Well, you could have invested in the index, right? But you would have gotten half of that. So in these 7 years, 12, 13%, but multiplied by 2.2 net of the fee. If you would have been in FTE, then you would only have 50% more of your initial investment. And then prices also entail what we said earlier, the closing of funds. We could, as a business strategy, lower management fees and manage money for American endowments that have billions of euros. But what would be the impact on us? Investing instead of 2.5 or 5 billion euros, investing 30 billion. Well, what we did when we designed the company was to design a price for a closing strategy as the one we have, and limiting assets so that this can become a club, an investment holding, and a group of aligned investors who do everything that is necessary to guarantee that the circumstances occur in order to maximize capital. I think that last part is very important because we don't talk about this often. And the endowments, very large endowments, have asked us to lower fees, and they had the intention of investing a great deal, and we said no, precisely for that reason, because we have a notion of what our capacity is. The return and the size don't always go hand in hand, and we have very loyal to that idea. But it has happened. They have knocked on our door. They've done the due diligence. And at the end, we did not reach an agreement because of the fees. Otherwise, we would have a lot of large institutional funds as clients. Great. Javier, for you, are you going to include a new manager perhaps in the Managers Azvalor fund? Well, yes. We've been for more than 20 years picking managers. We have thousands of managers that we've met throughout the years, but we also know that a very small percentage beats the index, beats the market on the long term. So what has happened is that we've said no to most of them. 99% of the analysts that we analyze, we say no to. In the last year, we analyzed 120 new managers that we did not know of the type we like, boutique type, limited capability, with a lot of experience, and in general areas, general managers, as well as specifically of a given area. Some that only do Chinese equities or Asian equities, or Latin American equities, different sectors, technology managers, biotechnology managers, where it's more difficult for Azvalor to get. But it's very difficult to find managers that, on the one hand, have the same quality of the managers that we already have in the fund in terms of their structure ecosystem, and that they have a very interesting portfolio with such cheap and sound companies as the ones we have at present. So at the end, the question we ask ourselves when we are analyzing a manager, the asset test is, would I invest 100% of my money with this manager? And we only go ahead if the answer is 100% yes, and if Fernando, Alvaro, and myself agree unanimously that we would. Having said that, we keep analyzing managers. We have a few who seem to be very promising. We'll see whether they succeed. And of course, the door is open to include more in the future. It's very interesting that you mentioned, Javier, that out of the areas you're looking for, some of them are very attractive. You have a very interesting due diligence done in people who are specialists in technology. They look great in China and in technology. They haven't gone through all the tests, but very hopeful. What I don't have in Azvalor, I have in the fund of managers. That is a collection of the best managers in the world, and they can invest in things that we can't. Yes, we've looked at dozens of them in those regions. We sat down with some of them who we thought had the right characteristics that we were looking for, but it's very difficult. What we're not willing to do is to lower the quality of the manager that we include in the fund to have exposure to a given area or sector. If the quality is not there, he falls off the list. So it's not easy, but we're still working on it. And 100% of my time I spent looking for the right managers, apart from monitoring the ones we already have in the fund. Great. This is a double question, and it's exactly the same. What is the correlation that exists between International Azvalor and Manager Fund? Is it worthwhile having both portfolios? Isn't it better to just pick one? Well, we were asked this a lot. In terms of investment portfolios, with a few exceptions, these are completely different portfolios. Just to give you some information, the overlapping between both Azvalor Managers and Azvalor International is 6% overlap only. So 94% of the portfolio is in completely different companies. That in terms of each company. But if you look at with a bird view, if you aggregate, the more important difference at an aggregate level is that Azvalor has more exposure to companies of a very small size. I said that in my introduction, about 65% of Azvalor Manager companies are small caps and micro caps. In fact, in Morningstar, where I used to work, the fund is classified in a different category, which is a global equities of small companies. Therefore, these are complementary portfolios with different names. And in turn, the four managers, once again, are very different. And this is a fund that allows to diversify our investments for the Azvalor employees as well as all co-investors. It gives them an alternative to have access to other management teams with different portfolios and different portfolios vis-a-vis the indexes. What we do share is, well, the quality. They do share some qualities that we cannot give up. I mean, they know the companies inside out. They do a comprehensive analysis of the companies. They have an obsession to buy cheap below the value of the company, and their interests are aligned with ours. We invest in our own funds. We demand our managers that they invest in their own strategies. So we have 4 management teams working for us in one single fund. Each one of them has concentrated portfolios in a limited number of companies, but in turn, Azvalor offers this diversification opportunity if we aggregate the funds. And in areas where Azvalor, the Azvalor team, it doesn't reach, is not a specialist, it is an area where the Azvalor managers now and in the future can complement the other one. Thank you. We have a question on the quarterly letter that I think reflects the thought of other investors. Thank you for your very good job in these past few years. For a few quarters now, the quarterly letter, the quality has not been as good as it used to be. You don't give us information on or data on investments and on the companies. I think they've lost my interest. When are you going to write quarterly letters that are interesting again? Well, the quarterly letter, we provide key information for us. What is the listing of the fund? How's it going? Giving more information, we've done this in the past, and I think it's not good. It's not good for most clients for different reasons. I wouldn't say more. I think it's obvious. It doesn't help. It doesn't help. The only thing we have is intellectual property. And, it doesn't make sense to say why we decide to buy or not buy. That is our intellectual property. Frankly, if the CNMV doesn't force us to make the quarterly letter, we won't even publish it. It's not mandatory in other markets. It doesn't seem much, but it's all we have. It's our intellectual property. So explaining what we invest in and why, that is not good for us vis-a-vis the competition. We're giving up what we have, our most precious good. Perhaps you want to have an opinion on whether you like our portfolio or not, in every point in time, but I encourage you to see us differently, to see us as a sound process with a 20-year experience that gives you a very good performance on the long term. And say, well, I don't like coal mines anymore. Well, I understand that you would want to see that information, but I want you to see us as a shelter for your savings. Talking about coal companies, are you positive vis-a-vis in the midterm? Do you think that coal companies in the future can be the new tobacco companies with a recurrent profit and dividends? Well, we don't invest in the coal sector based on a vision of the sector. And we're not carried away by narratives like they can be the new tobacco companies with a recurrent profit and dividends. We have invested in a few companies, coal mine companies, and we've made a lot of money in them. I think you know the case of Consol. It was 30, went down to 30, then went up to 80. White Heaven is a company that we bought at $1 or $2 per share and went up to $11 per share, not at $7. Arch Resources, a company that we started to buy in at $50. Now it's at $160. Alliance from 5 to 20. These are very specific companies with some given characteristics. Others also went very well and we didn't buy. I remember Pivot. We were thinking about it. It was at $1. Now it's at 26 and it went up to 30. Basically, their debt that was the reason why we did not buy. We're very conscious that what has happened is not everything that could have happened, and that could have killed us. But the most important thing is that there are other companies, coal mine companies, that have gone bankrupt. They're worth zero today, listed and privately owned. Murray, Cloud Peak, Westmoreland, Mission Coal, Black Jewel, and many more. There's a long list of these companies that have gone bankrupt. So you can't think about this in terms of sectors. Of course, you need to understand the sector very well because coal is a very heterogeneous commodity. There are many types of coal. And then you must understand all the supply and demand factors. You must understand the industry cost structure, the industry cost curve, the logistics, which is so important in the case of coal because relative to its weight, it's not worth very much. You need to understand where the new mining projects are, how much does it cost to build them, to extract, what is the incentive price for those mines to get a good return. Also regulations, which changes by jurisdiction. Bear in mind that thermal coal, for example, the one that is sold in Europe in the Atlantic Basin, it's been sold at its lowest moments at $40 per ton and at $400 too. Or metallurgical coal that was sold at its worst moment in the last cycle in 15 or 16 at $75, $80 per ton, and 2 months ago in 2022 at $600. Now it's at $350. So you need to be convinced based on your work of what is the equilibrium price on the long term to value these companies. And for that, you need to study the sector. But the second part is to study the specific companies, its mines, its reserves, what are its costs, why do they have those costs, if they're sustainable or not throughout the mining plan.
El equipo directivo, the management team, what they've done, what's their reputation, what incentives they have, how they allocate capital, balance. Well, there's a long list. List is myriad. It's not easy. Obviously competition. You have to study all companies involved. You have to understand the whole field out of the processes, possible substitutes. Not only coal, I mentioned gas. We've got the same situation. We've had to study the gas market. We've actually invested in gas producers. We've had Chesapeake Energy, Race Resources, Epsilon, and, well, we find ourselves in the same position. Gas in the U.S. in, I think it was 2007, 2008, was $14 throughout COVID. We're talking about one and a few cents, and then we went back to 10, and now we're back to 2.5. So, well, we have to understand the whole situation, what the costs are, the economic unit, the pit, and different basins. So we've got the Appalachia Basin, Marcellus-Utica, you've got Pennsylvania and thereabouts, Hinesville in Louisiana, Permian in Texas and New Mexico. Gas here is a subproduct. Shale gas, so you have to understand crude oil to understand gas in the Permian. Then you've got the DJ Basin, Anadarko. And that's just American gas, which competes with international gas, and there are very different markets there. So we've got the one that's being sold via pipeline, and you've got different projects, so there can be competition, gas lines that connect with Russia and Europe, Russia with Asia. There are new projects there, north of Africa with Europe, and you've got, well, of course, liquid gas, LNG. You have to take into account how it's processed, where it's liquidated, how much it costs to transport it. Then there are markets which have long-term contracts which are pinned to the price of crude oil. Then you've got the spot, and we've reached prices which LNG, which it's been higher than Brent. We're talking about $200 equivalent barrels. So you have to study all of that, and in order to reach at the end of the day, I believe, which is the valuing of a company with all of these and all of these companies in charge. So you can't reason sector by sector, much less, well, falling in easier narratives. And no, of course, and anyone who was interested, well, you have to go sector by sector. Yeah, wonderful. There are a couple young people who want to ask about that, about value further down the line, but let's change sectors and let's go to banks. Well, first, we want to congratulate you for your wonderful results, the wonderful job you've done. I'm sure that the monetary policies that central banks have implemented made you predict the high inflationary situation we're facing in this context seems to give banks an edge, but you haven't been able to take advantage. Do you think that there's a short way to go? Well, if banks take advantage of banking, and well, banking is a very difficult situation. It's a very difficult field. It's a very difficult sector because you can't really know how many bad loans there are. Banks, let's say they've got 100 balance and they've got they're leveraged 20-1, and that's last time I checked, but it's a leveraged business, which means that if you miss 6 out of 100, you miss all of your own funds, and they say that inflation gives them a profit. And well, this is a very simplified causality situation because at the end of the day, rates, you can have an intermediation rate, but if rates increase because inflation increase, I've got questions for this client. Do they go up or do they go down? Because if there's inflation, it's not the same thing if there is or not a recession. What happens with operational costs? You have to pay people. What happens with market value, which is slightly more technical with your bond portfolio? If you've got a bond portfolio, well, at the end of the day, there are certain implications. But all these questions are just the beginning because you have to analyze each bank with their own managers and everything. And then you have to take a look at how, if all of these current prices, this is attractive or not. We've taken a look at this, and if this is attractive or not, well, this has an impact on everything. Our friends and investors, and well, That's where we see it. We've got a question from someone from here because you've answered it, because they were asking if the financial sector will be impacted by this, or if they will, well, if NPLs are going to have an impact. And this, we've already answered this. And there's a second question came before this one, which is, I lost it. So where is it? Here it is. Why has the banking sector given us an advantage when they told us that there was a huge security, there's a huge discount on value over tangible assets, et cetera, et cetera? It's a question pertaining to everything, to organize different matters, different aspects, or do they simply not believe in the sector? Well, I think that we've already answered this question, because in the past we've found something relating to banks, and we've had good profitability in the last couple of years. You can't puff your chest up, but you don't have to hide it. But we've had an impact in the past. Bank Inter in 2011, I think it was, when Línea Directa had a share of Bank Inter, and well, we had the bank for free. And well, when we take a look at this, well, this is an easy question. This is where we find ourselves. And well, we've said several things. These clients have said several things. And well, why do we do this now with discounts, high discounts over accounting value? Well, this is very interesting, but there are many things there. You assume a lot of things, which maybe are, maybe not. And well, I would leave it at that for the time being. Very good. And from the insurance sector, could you please explain why you're interested in the Spanish insurance sector? Why haven't you bought insurance companies for our international fund? Thank you very much, and congratulations for a wonderful, wonderful trajectory. Well, it's an easy question. Why have we bought only insurance in Spain and not everywhere else? It's easy to analyze. It's a difficult field to analyze, not as much as banks, but it's difficult because you never know how much insurance can lose, because if suddenly they reduce prices in order to get more, and they insure, well, more daredevil drivers, but I'm using auto, but it can be different insurance. But when I insure someone at a lower rate, well, you don't see anything, but this has an impact on our risks. And, well, I want to insist in both at home and in companies. To do so, we have to be aware of the firm's culture, just like Azvalor. You know, you can already predict that Tesla isn't in our portfolio because you know us. It would be nice to be able to predict if Catalan Occidente or Línea Directa are not going to organize a campaign to get 18-year-old drivers, because that would have an impact come tomorrow. You have to be aware of the culture, the impact of bonuses. To know all of this, the impact, and well, at the end of the day, this is something we can do. This has had an impact with MAPFRE, and we've had very positive results. And well, this is very difficult, but beyond business, there are lots of rules. You've got underwriting, offering insurance policies, then investment, because at the end of the day, insurance get your rate on January 1st, but you don't get it back when you have an accident. And Buffet has been for a long time in insurance, and not everyone can invest like Buffet, and we have to analyze that from that point of view. And in Spain, well, we know how Catalan invests, how Línea Directa invests, so it isn't easy to know. But as you can see, there's a long laundry list. It's a good question, don't get me wrong, but that's why we can know how it happens in Spain and outside. No. But there have been some exceptions, internationally speaking, given that culture, having been aware of it, such as Fairfax, knowing Premacha, with whom Fernando and I met 7 or 8 years ago in Canada. Well, knowing Prem, you can know. Well, you can buy a Fairfax, and you can be calm. There are good insurance companies that I'm not going to mention because maybe we'll buy. They have very good culture in European insurance company, but outside of Spain, I don't think we're going to be able to gauge those cultures, because the good ones, the good companies aren't cheap. So, and you can't say that it's expensive and you can't say head I make and tails I lose. So you can't just, this isn't head or tails because let's think about generally companies that size. You never know without any skin in the game what incentives, what campaigns, and again, their leverage, it's not 21, but it's 10 to 1, 15% error. They lose their own funds, and well, given our situations, and it's going to be difficult. Okay, some more questions for Jose Maria, for Valor. I'll ask them as you climb up onto stage. You've talked about selecting the investment. Is there anything similar in Davalor? And if there is, what is it? Well, yeah, I'm glad that you asked us, that you're interested in, well, we don't fight bears. We work in Africa, so we fight lions. But the fact of the matter is that we have a process which is just like Azvalor looks for companies where there's managers they trust, there's a family that's invested. Well, we work with people who give life and that are devoted to health, to education, who stay there no matter come tide or come hell or high water. They stay there. They've got skin in the game and they take part. And these people, these nuns, which we've known for a long time, these religious organizations and other ones, they pitch projects. So projects come from the south. Once down south, the volunteers we have on the ground, these are volunteers which are 100% of what we receive in Africa directly, and in Davalor comes from the field. So they pay for their own cribs. They remain there for 1 or 2 years, and we've been working there for 3 years, and they learn a little bit from processes, and they can see how this project evolves, what it needs, what investors have asked them, and what the sisters have tried to do. And then I like visiting. We've got several people. We've got a lot of volunteers here. But I usually visit. I went to Uganda, and this year I was in Madagascar, Malawi, Zambia. And once again, we receive 100%. And I've been working here for 30 years without a salary. And I've got the honor of being here with you. That's my salary, talking about the wonderful, wonderful things we do. And well, once a project starts from the south up north, we gauge it. Then there's a committee, an evaluation committee in Africa, which studies it and decides, well, we like this project or not, and we want to give it to Davalor. And that is to say, we choose the most beautiful projects for Davalor. They're all gorgeous, but there are projects which go above and beyond, and which the Azvalor is going to enjoy. So we talk with a different committee within Davalor, and we choose which ones are going to be funded by Davalor, and we follow this process. But once we've chosen these projects, there's a financial department which follows all the management. There's a treasury company which is completely independent, which pays. A lot of our volunteers are people who are pre-retirees from banks, from companies, financial directors, who are the ones who pay, which means that we have lots of volunteers, and well, they keep an eye on each other. All payments go from our accounts to their accounts, and they undertake the projects with the help of local volunteers, and with visits we organize to gauge how everything's going. And then we have audits, because we aren't required to audit ourselves. And well, we have an audit because we have auditors to cover the cost of the audit. And well, that's more or less the process we follow. And there's a second question here, which beyond a question is the declaration of intention, is if you could explain how we can donate to Davalor. Well, thank you very much. Well, a lot of you have already helped Davalor. Azvalor's website has a little green tab which discusses Davalor, and that's where you have the account. You can transfer money directly to that bank account. You can do anything you want, really. You can a receipt so you can help every month. Like you can have a monthly impact. There are people who have called us who want to leave a legacy for Davalor, and well, we've seen everything, and well, there is different ways of reaching those €3,000,000, €3,170,000, which we explained earlier, which we've gotten all throughout the years. But this last year, with the increase of the liquidation, well, a lot of donors and co-donors, what they've done is they've donated shares. So, and what Beltran was mentioning earlier about the 10 shares, which had cost €1,000 and that were now 1,200. Well, 2,200. Sorry. Well, they've gotten €1,200, and some people said, I'm donating 10 shares, or I donate X amount of shares, and when they donate those shares, they are unwriting that, but they don't have to pay. So, well, a lot of people have helped us and have helped Davalor, and they've given us current value, but accounted for them when compared to the old value, and they don't have to pay. So I think that's been a wonderful idea. So you can keep on helping Davalor. Well, thank you very much. Hello, Fernando. We're getting a lot of questions now. And what potential do you see there with this situation? Well, Griffols, in order to describe this, is a pharmaceutical company, which is the second one in the world in human plasma medication, which, well, we're talking about medication, which is good for immunodeficiencies and, well, hemophilia, chronic pulmonary obstruction, similar. This is a world oligopoly, which has grown in the last couple of years at 708%, and the key competitors are, well, an Australian company, a Japanese company, and one or two places all around the world, and then we've got different ones. And, well, the company which went public years ago and which is still controlled by the Griffols company, well, they started a very strong growth project some time ago, and, well, they reached COVID and they faced COVID with everything changed, a lot of debt. And, well, COVID at the end of the day is a situation that's affected a lot of people. And, well, this is where we've started seeing problem. The company has a lot of debt, and they are restructuring, and they are going to sell some non-strategic assets, which, well, it isn't clear if they will be selling them, when they'll be selling them, how much money they'll be getting. And, well, at the end of the day, we're talking about growth factors within their market are very solid, or, well, they seem very solid. They've been very solid, but they're not set in stone. And growth is, of course, something that obviously worries the market. And like in all businesses, there are threats and substitutive products for different companies. And, well, we've got recombinant or biological products, which are laboratory made, and they're being clinically tested, and which could substitute some medications for some situations. And the company has made a very important decision, which is it's a historical decision, which is for the first time having someone head the company who wasn't from the company. And, well, this is a company that's been listed above $20-something, and they plummeted as low as $6, and now they're at $8. So that's our analysis problem. We've gone over all of this, and of course, well, we're of a very clear mind, which really solve this, and at the end of the day, well, that offers a certain value to the company. And, well, next one is, what do you think of Técnicas Reunidas? Well, that's a company that has had a huge situation. We're going from Repsol to a world-leading company, and it's a company that's undergone a crisis where oil is negative, and it's grown quite a bit, and it could reduce everything. And we can also say that given our crude oil market well, this is a wonderful situation. They listed at 60 and as low as 5. So, well, it's not where both. So that's the question at the end of the day. Now the situation is much better and we can add more with less risk. Well, these are the dilemmas we're facing here in Azvalor. Well, a couple of questions for Petra Diamonds. And if we take a look at the market, our Petra Diamond situation, why do we trust so much diamond mining company? Is it relevant? Well, it's one of the few large mines. Petra owns one of the small companies. Petra went bankrupt and investors kept it. We weren't investors. The company is clean. The assets are good. Our new management is reasonable. There are challenges, of course. The company's in South Africa, and there are challenges, of course. There are bears here as well. But, well, if not, it wouldn't be. We like it, but because if not, it wouldn't be part of our portfolio. Wonderful. And 3 questions on Tullow. We still have an important position in Tullow, but it's an oil company that's been worse, and there's a person that's asking the same question currently. And finally, if you want to ask, I'll ask you some more questions as you answer. There are more Tullow questions. Okay, wonderful. What do you think's happening with Tullow so the market doesn't acknowledge its value in their listings? And what do you think of the coal market? And we've seen Tullow has gone from 250 to little over 1 cent, and it's gone back up to 60 cents, and right now it's in the environment of 33 cents. Can you explain more or less how it's grown? And, well, congratulations and thank you for your work. Wonderful. Well, I think that coal, we've already mentioned this, but Tullow, well, it wasn't, I think their historical minimum wasn't 1 penny, it was 5 pennies at their worst times. But anyway, Tullow, 7 pennies. Tullow is, as you all know, it's a company that was a huge success story when it started, and, well, then given huge growth and a lot of investment, they reached the first oil crisis in 2015 with a lot of debt, and that's when the problem started. Then we had COVID with operational problems, and, well, and the problems we had, the balance, and how this was solved in 2017, and then the company is being restructured, and the management has changed, and everything, and there was a huge cost reduction, and it was refinanced. Debt was refinanced in order to push back due dates, and, well, they reduced their explorations down to minimums, and, well, let's just say that the company right now is reinvesting in order to grow, and their assets have fallen given a lack of investment. And, well, the first problem we find is if the price of crude oil will be enough so the company can invest in their assets and at the same time comfortably give a response to that. There are different matters that we have to solve in our analysis. We've got a very important asset in Kenya which isn't producing and which is still pending some sanctions, and the company is waiting on the incorporation of a partner which would face an important part of the construction of the assets. We don't know when this is going to take place, how it's going to take place, how much this asset is worth for Tullow right now. Well, we're facing a deep financial situation and to restructure their debt, and this is one of the Tullow's key assets, and Tullow is in court given some asset situations, which in Africa is, of course, business as usual, but those are, well, that's our coming storm. And last year they had to clean some stuff because they also are covered, and We're talking about 600, but well, no. These are the situations and which we have to solve, and these are the ones that we are, of course, have used to wrap our heads around it. Very good. He asked, what's your mission in Ferrexpo? Well, that's a company that lacks a little bit of liquidity. It fell a lot, and then it's grown quite a bit. So, if we're selling, but we still have a long way to go, I don't think it would be a good idea to comment on this. I've got Azvalor in my portfolio as a key part of my conviction when it comes to producing goods, precious metals and goods. Are you going to leave these assets if the situation changes? Is there anything I should take into account? Well, at the end of the day, value and pricing, it's good management. It's when we take a look at, we've got gold and metals, so we have all of this. So, well, at the end of the day, this is the possibility of rotation. I think that that's something we can rotate in a very good situation. Very good. This is employment plan. You mentioned something given the change in pensions and employment plans. Can you talk anything? Well, it's what we mentioned. The Law 12, 2022, well, basically got rid of a lot of the maximum contributions for pension plans, and we're focusing on employment plans, and then it's offered a collection of advantages. So what we've done is we've created a platform which isn't more than a promotion plan. Beyond, that's the important part, which any company can join without having to have their own specifications and adding themselves to a plan where different companies have already participated with very good advantages and having the opportunity of joining a plan that already works. And if there's any interest, because this is going to be very good, because we're going to be operational in a few weeks' time. And another question pertaining to uranium. Do you believe that investing in uranium-related companies, do you believe in that? Or is there no longer a chance that, well, we love nuclear. I think that it's part of the solution for a greener and cleaner world, and especially with continuous current, and that's how it's been defined. And uranium companies have grown quite a bit, of course, Cameco among them, but we still have some opportunities which, well, at the end of the day, it's price value in the opportunities.
Are you going to invest in clean energies? Well, we invest in profitable, well-managed businesses where the shareholders are priority and at a good price. So anything that we can understand, we can invest in. By understand, I mean, foreseeing the next 10 years. Cameco, 7% produced clean energy. We invested when it was cheap, and it didn't have that rating yet. I think Fernando said this, our motto is buy cheap. Clean energies, just buy cheap. Well, we're invested in some power companies that have a different photovoltaic, and indirectly too, we have invested and still have investments in materials that are absolutely essential to facilitate clean energies, nickel, copper, cobalt. So yes, we look to invest cheap, and sometimes it is in these industries. The international valor is focused on energy commodities. Although you've had excellent performance in the past 3 years, we are taking on a risk vis-a-vis the future. That's a very high risk. My question is, don't you think you should diversify that portfolio and diversify in sectors that won't grow at the same pace and might suffer a correction? Well, Fernando explained it in the introduction, but I do agree with this gentleman. When shares go up, it's the time to sell. One, on market timing. Sergio perhaps could answer this question. Good afternoon. I know that you recommend avoiding market timing, but you also recommend recurrent payments that reduce the impact of volatility. If you get extraordinary income from an inheritance, for example, how would you include that in the fund? Let's say I have 1 million funds. Would you invest it in one blow or throughout the year? How would you do that with your own money? Well, good question. But it's more psychological than technical in nature. What underlies that question is a temptation to try to predict the future, as we said earlier. If I think that something is going to go up, I invest all of it now. If I'm not that sure, I don't invest all of it. Well, excess liquidity that I'm not going to need in 5 or 7 years, I always have it invested. You try to anticipate the market. That is impossible, and it turns out to be very expensive. Some friends called me when it was 180. They were going to be you were going to take it back, and now, I mean, it's very difficult to predict. It's like with a Peter Lynch fund. That's what he tries to avoid. When you win the lottery or you get an inheritance, yes, but what we recommend is when you can calculate the excess liquidity you're going to have and you can make recurrent contributions, which is what I do with my daughters. You make small contributions recurrently and you systematize the savings. I think that's a very good way of doing it. Making small contributions after 10 years, that gives you very interesting capital. Thank you. Like pensions, yes. You've proven it other times. But explain again why equities on the long term is better than other things. Well, Stocks for the Long Run is the title of the slide. It's slide 22, Annex 3. There you can see, there you see what you get from treasury bills, bonds, equities. After 200 years, look at the difference. The explanation is that stocks are a part of a business, and the price can go up, and then you have inflation. What is the potential of the new technology? Like, because of course new technology gives you tools that you didn't have in the past. Could these new tools be used now? Well, value investing, as we said, is an attitude and a process. Obviously, new technologies can always help. I've already used ChatGPT for some things, but the difficult thing is not to run when you see the bear coming. I don't know if artificial intelligence helps you to stand still. Well, what percentage of your net worth is invested in your funds? 95% or more in my case. That's my financial net worth. 100% in my case. 100%. Most of it, and then we have some value managers, because I still have a small percentage with others. I have a new one, like Miaga, which is from Rafa Leon. But these are emerging managers that I like to invest in them too, but it's about 2%. Financial net worth, most of it is in Azvalor, including the managers fund, yes. I know, yes, managers isn't. I know it's an Azvalor fund. Thank you very much for your good work and the opportunity of asking questions. We value your full-time dedication and that of the managers. But looking forward, since Azvalor is bigger with more products, and can these reasons have an impact on the focus of the managers? Well, thank you for your thanks. And now we have a very explicit process. Venture capital, we will do it if it makes sense and find someone who knows how to do it. But what we do with Azvalor is what we do with our money we share with others. But we shouldn't change what we're doing well. We're doing very well for 20 years. Taking into account, this is of practical nature, take into account that sophisticated digital means are tablets and smartphones. Have you thought about building an app? Yes, we talked about it some time ago, but we prioritized the private area for investors and the different functionalities of our webpage. Digital signature, direct payment, the different functionalities that we have developed, we prioritize that. The app, I think, is a good tool to offer all of you and ourselves to have easy access to the information. Yes, the app would provide more functionality than the web, but this is not the right time to think about it. There's something negative about it, which is that having an app in your cellular phone, you're going to be looking at the value every day, and that's what we don't want. That's the only disadvantage I see in having an app. But yes, it is a very useful tool. This one says, you've focused all your time in investments, etc., but lately you perceive a greater presence of the managers in the media. Is there a reason for that? Well, I don't like to talk about these things. They're very private, but I think we have 4 lunches a year with clients, 6 one-hour interviews, and the annual conference. That is how much time we spent doing these things, interviews with the media and so on. It's, less than a couple of days of work a year if you put it all together. So most of the time we do dedicate to invest and manage. And managing the company, we spent some time on that at the beginning, but now Sergio is taking over more functions. He's head of HR, head of compliance, head of business development. He's almost like the general manager. And that means that Fernando and I have more time to do other things. We have a management committee just a couple of hours every month. So, and then we have somebody else who works with us, a former consultant, not full-time, but he is managing a very deep transformation project and the database to help us to industrialize a response to all those clients who have small net worth. So all these people are doing things that allow Fernando and myself to invest only. And just we spent just some time, but very little time really with those dinners and interviews, as I said earlier. 98% we dedicate to invest and manage. Right, thank you. A question here. The target price of the takeover bid, can you talk about that? I don't think so. Okay, then let's take the last 4 questions. No, not 4. There was another one here that I would like you to answer too. Now, the conferences before, you've been reluctant to buy housing. Fernando, if you didn't have a home, would you buy or rent, and why? Well, we've explained this. I don't know if it's in the slide. I have a slide with, when I give a talk, I use that slide. I didn't bring it here. Investing in equities is greater than investing in housing, in real estate. Of course, if you don't have a home, I think it's a good idea to buy. And I would buy. Not to optimize the return, but because it has other advantages and some virtues. It forces us to save. It's easy to finance. It's an actual asset. It's good to fight inflation. Obviously, if there isn't a price bubble, which usually happens when there is too much growth of lending, which happened in Spain until 2010. It stopped in 28, but then it didn't burst until 2011 or 12. So if it's your first home, yes, I think it's a good idea to invest in real estate. Just to add, there were moments where it was very clear, not buying between 2005 to 2008, and then from 2009, clearly it was a good idea to buy, buying at a fixed interest rate when rates were very low. Now the price is higher, but we think it will continue to rise. So it depends on the personal circumstances of the person. This time round, it's a difficult question to answer. Other years, it's been easier. What advice would you give to a 19-year-old who feels passionate about value investing? Well, I would tell him to start to buy shares, because that is what makes you put something, to play with something, to put your stakes in something, betting on something. And this is how you need to begin. Read and start to buy shares of a business that he feels an interest in, has an interest in. Last 3 questions. What was the worst moment in your professional life, and how did you get out of it? Well, you never get used to having the bear staring at you. In 1999, that was a very tough year for me personally. Everyone was making a lot of money around me, and I wasn't. Fortunately, it didn't last long. Then COVID, with 15 bears in front of me, that was not easy either. And how did we get out of it? Well, I recognize that not using my own forces. I always trusted in the evaluations that they were well done, but that extra motivation and energy I always have had from outside, from my wife, my children, feeling them close to me, my partners, of course, Fernando, whom I've known since I was a kid, also Sergio, the founding partners, people like Javier Campos, who has been key in the organization. He was really doing everything he could. Javi also, our secretary Rosalia, who was alert all day long, Bea and the trading team, people who, they're working from 7 onwards when it's necessary. If they're there, they're with you, supporting you, that encourages you. But in my case, the support came from God. That's how I feel it. I wouldn't be honest if I didn't say it. I feel God's presence every day. And to paraphrase Rocky Balboa, he allows me to stand another round when I don't even believe I can do it myself. And also, we have bad times too. The question was for both of us, what about you? I already answered. I remember a very bad time was the global financial crisis, when the funds fell 60%. And I saw around me my relatives and friends. I saw they were selling companies. They were afraid. Some had to. Some were very much in debt and they had to sell. And of course, you suffer because you realize that they're making a mistake. So they sold their shares, and that was a shame. And this is something that has been studied. The human brain falls into a false identity. Prices falling is equal to more risk. And it's curious because if there's an apartment and the price falls, you see that as an opportunity. But in the stock exchange, it's like disaster, and but it's the opposite way. So people make bad decisions, and then they're sorry for that. How did I solve it? Well, I was with a company in the company of my family and partners. But one of my relatives said, well, stop. This second to last question, with regards to skin in the game philosophy, isn't it contrary to diversification? For example, if funds didn't work out for you, everything would crash. And isn't it better to separate things and not have all your eggs in the same basket? We've always had all the funds. Sometimes they were not doing that well. They fell once 50%. But we're not diversified, says the person who asked the question. That's not true. We have 70 companies throughout the world. We're complemented with the managers' funds to the places where we can't reach. That's another 100 companies. We have top-notch depositories, BNP, etc. In 2001, the stock exchange crashed by 50%. Then there was another crash. The key is to know that troughs and peaks are transitional. They will pass. But the question is not a bad question, because if everything bad happens to you at the same time, how you're going to manage the company? Well, it happened, and here we are again. I personally think, or what I recommend, is to the money that you're not going to need in 4 or 5 years, leave it there, so that you don't have to escape when it's the worst moment to do so. And I think all of you know this, because when we fall, you invest money. You don't take out your money. This is why we can do our job. If you took out the money when everything fell, we couldn't do anything. So this company is special in that regard. So leave out the money that you're going to need in the next 5 years, and the rest of it, leave it, and you can resist and not make rush decisions, because that's not how we make the decisions in the company. We give our opinion, but in that scenario, we would not ourselves make that decision. We have a human resources policy, we have a regulation policy, vendor management policy. Fernando, would you like to add anything to that? Did the question maybe refer to diversifying in the sense of losing in the skin game? No, the risk of having everything invested. They want you to continue, to go on. Yes, but that would go against the results. It's too much skin in the game. Some people have told us that. And the last one, if you could keep one thing that or describe one thing that you did last year, what would it be? The process, I would say. There are things that were done really well, companies that went up a lot, but we mustn't judge good decisions just by the result. Maybe there was good luck or bad luck. We are probabilistic, and we like to answer the easy questions in the exam. What we've done well is that we have a culture in the firm, and everyone knows, depending on what stage the company is in, they know what they need to do. So everything flows in the company. That's what we did well, the process. But not only this past year, it goes way back. I know what I did badly. That's very clear. You haven't done anything bad. No, yes, I did something bad, but I'm not going to say it. I don't know what he's talking about. Well, we don't have any more questions. Well, thank you very much, everyone, and we hope to see you again next year. And thank you so much for your attendance and patience. We've been here for almost 3 hours. And thank you for not sending when it reaches very low levels. When it reaches high levels, I don't sell. But without you, it would be impossible. You're 50% of the equation. So we could be more grateful, and we hope not to disappoint you in the next 25 years. Thank you.